Hi everyone, this is Eric from Traders Helping Traders with this week's Tricks of the Trade. I got an interesting email this week. The question from the member was regarding how do we add additional contracts to an established position? And that's an excellent question. There's several ways that you can look at adding contracts. I'm going to show you the one that I prefer, but before I show you that, let me just briefly mention that most people are only aware of adding contracts via the Ken Roberts method. And Ken Roberts, whether you love him or hate him, he got a lot of us into this commodity trading business. The Ken Roberts method of adding markets or adding contracts to your position is to add another contract once the existing position has earned enough profit for you to add another contract. So whether the market is heading higher or lower on that particular day, if you have earned enough in your existing position to fund or margin another open contract, then that would be your cue to buy. Now, Ken Roberts has a system that he refers to as pillaring. So if, for instance, you buy in soybeans and the margin on soybeans is just shy of $5,000, we'll say $5,000. Once you have earned $5,000, you would double your position. So now you would have two contracts working. And then when those two contracts earn another $5,000, well, you would add a third position. And what you end up doing is you end up building an upside down pyramid. A pyramid that's going to look something like this. Well, I drew it wrong, but you get the idea. Hold on. There we go. And what happens is it's like a funnel where you have one contract down here and it gets higher and higher and higher. And you could be floating as much as 16 or 30 contracts depending on your account size. The problem with this is the reverse leverage. When the market moves against you, all of a sudden you may have 20 or 30 contracts moving against your position. And of course, those losses are going to add up a whole lot faster than your profits did. So a very dangerous type of strategy works very well if your timing is spot on, but otherwise you could leave yourself open to some rather substantial losses. The alternative to the pyramiding scheme is to pillar your contracts, and the way that would be is you would simply add one more contract for every time your open position earned another margin. And so, for instance, say down here you bought your initial $5,000 soybean contract. The market moves a little higher. You earn another $5,000. You add another contract. It earns another $5,000. You add another contract, and so on. And you simply just add one contract, and that makes a slightly more stable type of position. So when the market does move against you, you don't have that inverse pyramid working against you. If you don't understand that, don't worry, because I don't really agree with either of those two philosophies. The philosophy that I agree with is either the upright pyramid, like the regular shaped pyramid, which would be like this, or a gradual way of adding contracts, which I'm going to show you in a second. The upright pyramid, as you can see, is much more stable, and the idea here is that you know at the outset how many contracts you want to have open in your position. So say, for instance, your account looks like you're going to be able to float, say, 6 open positions in soybeans. What you would do is you would start your trade with 3 contracts. And then as those contracts progressed, you would add 2 contracts. And then lastly, you would add 1 contract to give you 6 open positions in the market. The upside for this is if the market moves against you, the single contract up here is not going to deteriorate the accumulated profits of the other 5 contracts that have been earning money since down here. This is a much more favorable strategy to use, but it does require a little bit more planning and commitment on your part. Now, adding contracts has always been a difficult proposition. Many years ago, there was a trader with the trading handle Phantom of the Pits, and he had a bit of a following. He was an active pit trader, and his philosophy, he had two major philosophies. His first philosophy was that as soon as you took a position, you would make the assumption that you were wrong on your position. Now that flies contrary to what a lot of traders think, but his reasoning was that you automatically assume that you are wrong, thereby you take your loss very quickly. And because he was a pit trader, he was able to really minimize on his losses. His second strategy was that if the market started moving in your direction and it looked as though you were right, you added on to your position as quickly as possible. Now, he never really clarified what he considered to be an entry signal for your next add-on, and there have been some noteworthy strategies developed over the years, the most famous of which developed by Richard Dennis of the Turtle Traders fame. But his was rather complicated. It required a lot of mathematical calculations. It tried to calculate the volatility of the market, and thereby in a more volatile market, you would take, it would tell you where you would add on to your next position, and on a less volatile market, it would also recalculate the figures and tell you where to take your next position. Okay, very complicated. I use a much simpler system. First off, I should let you know that when I do take a trade, I usually just trade two contracts. I'll take two contracts out of the gate and take early profit on one and let the other one run. But if you're looking for a strategy to add on to your contracts, here's one that I find works reasonably well. Now, of course, adding on to contracts is only a way to really capitalize on a trending market. If you find yourself in a choppy market, adding into contracts could prove rather bothersome because all of a sudden you're really adding up on your losses. All right, let's take an example here. This is the current soybean market, and we're looking here at a market that is trending. We have had the market put in a bottom here, and whether you see this as a support bottom or a 1, 2, 3 bottom really doesn't matter. It broke through our long period, 55 period moving average, came in, showed us resistance off of the old resistance here, and once again broke through, and here it came back down, and now we're testing resistance again. And you'll remember this from the other lesson, that's what we look for. We look for the market to test and retest. So here was the initial test, came back down, broke through, and now we're at the retest. There's a couple of ways you can trade this. If you are a more aggressive type trader, well, we have support here already. We have our red-green bar combination. This would be a buy signal. If you're looking for a little further confirmation, then you could wait for RSI to confirm that the trend has reversed before getting in. For the sake of simplicity, let's take this as our entry. And the great thing about track and trade is it allows you to play. I do this on occasion. Some people like video games. I will back test a chart. All right, so brokerage fee, well, $5 is fairly realistic if you are trading multiple contracts and if you have a really good discount broker. But let's say for the sake of this trade, we're going to be a $15 round turn, which is, or yes, $15, very reasonable. We're going to buy one because we're going to look at adding on here, and we're going to pillar this this market. So there's our entry, and we're going to get brought in. You can see margin at this particular point in time was $4,400. We're going to make a deposit though, And let's say we're going to deposit $25,000. Give us a little bit of money to play with. All right, so we have our position. Let's add our exit, stop, and away we go. So the market has advanced. We're up a few dollars, about 300 and change as of the close. Now, where are we going to add our next position? Well, what I like to do is I like to wait for the market to show me resistance, being a support and resistance trader, because once I have resistance, I have a better idea where it's going to be safe to enter the trade from. So there the market heads higher. Roll our stop a bit. Okay, now we have resistance. With resistance, I will now, if I'm looking to add positions, I will enter the market on a break of the resistance. And what this does is it usually helps me keep my stops a little bit tighter. Usually. Let's see how this plays out. Okay. The market came down lower. I'm going to roll my entry down because I'm looking to add a position here. I'll roll it down again. Because what I'm looking for is I'm looking for a big reversal. I want to get into this reversal now as quickly as possible. Instead of actually waiting for the confirmation, our red-green bar combination, instead of waiting for the confirmation of support, I'm looking to catch it early. Because if the market takes off big, if it makes one of these big bars, it might be way too much for me to cover, because don't forget, we're going to have to double up on our exit. Ooh, there we go. We got support. So in this particular instance, I'm actually able to bring it in above the support. And there we go. And now you can see what I was talking about. If we, say for instance, we didn't get this support bar here, but the market took off like this, well, now we would have a really difficult time trying to cover that. So we need to change this now to 2 contracts. And we are long 2 contracts. Okay, let's do this one more time. We'll play this forward. Okay, now we have resistance. We have our green-red bar combination. And I am going to go in just above the resistance. And here again, you can see resistance ticked lower. So, well, I won't bring it down too much lower. Oh, and here we got support. So we got a little bit of a lucky break, hopefully. And the market's stalling a little bit. Okay, now we're brought in. Now we need to bring in our exit stop. We need to adjust. Always remember to adjust your exit stop for however many open positions you have. And now, hopefully, the market will continue higher. Ooh, there we go. A little bit of a heart palpitation there for a minute. Okay, so far, just off of the 3 contracts, we are up over $8,000 just by adding to our position whenever the market gave us resistance. In fact, you could make a case that if you wanted to, I missed the resistance that happened right here, right? We had another green-red bar combination. But your account size does matter. It always boils down to what you're going to be comfortable with. You know, right now, $8,500 in profit. I might get pretty serious about putting that exit stop a little bit tighter. But let's say we wanted to try this one more time. All right. So there's resistance. We're going to put in our order above the resistance. And right now you can see how much money we have in play. We have about almost $3,000 in accumulated profit in play because we have multiple contracts. Ooh, the market's all right. We caught a real lucky break there. I almost thought we were going to get a reversal off of that. All right, so once again, make sure you adjust your exit stops for however many open contracts you have. And right now, we have, we're long on, this is our initial position here. We added a trade here. We added one here. We added one here. So we have 4 open contracts, and we are up. Well, we've pretty much doubled our money just about. We are up over $23,000. So it works extremely well if you happen to catch a trending market. Not so well if you're caught in a choppy market. But by waiting for resistance to come in before placing your add-on order, you're going to find that the risk exposure will be that much less. So a good little thing to keep in mind if you're looking to add to your trades. And that's this week's Trick of the Trade.